Ladies and gentlemen, please welcome Mark Engstrom, Executive Vice President of Acquisitions for HTA.
Those are all my friends. Good morning and welcome. On behalf of Healthcare Trust of America and Revista, I want to welcome each and every one of you to the National Launch and Executive Forum on the Competitive Advantage in Healthcare Real Estate. I'm honored to introduce Revista, a new data tool that will revolutionize the medical office building market and better serve the healthcare community. This new data service for medical real estate is a long time in coming and will create value for all of us here today. And I'm pleased that I have plenty of familiar faces in the audience, friendly faces, for this national kickoff event. And I know that during the day there'll be much to learn and share. It's a great opportunity to launch a product like this. At Healthcare Trust of America, we are especially proud of our partnership with Revista and our role in creating a new source of accurate and unbiased data. I'm personally excited by the potential that Revista can deliver. When I started my career in healthcare real estate 28 years ago, medical office wasn't even a defined asset class. BOMA had no medical office conference, and there wasn't even a hint that MOBs would be discussed in the same breath as industrial, multifamily, retail, and office investment properties. There were few, if any, institutional owners of medical office, and there was no professional property management or asset management programs designed to address the pressing real estate needs of hospitals and physicians. In fact, when I attended the first BOMA MOB conference in Berkeley, there were just 25 of us who didn't have a clue on where to get the data or even how the data would be put together on medical office real estate. Fast forward to 2014, there were over 1,000 professionals that attended the BOMA MOB conference in Nashville last spring, and we're still lamenting that the data is anecdotal and not disclosed in a reliable manner. Well, right here and right now, Revista is prepared to do something about that. Revista is offering a solution that has hindered the MOB sector, which is inadequate data due to its limited institutional investment presence in the sector. This has hampered valuations and institutional understanding of the asset class, and to date, most industry data has been qualitative, fragmented, and subject to a high degree of marketing bias. All this undermines the data credibility and makes it difficult to use it as a reliable source of information for rigorous analysis. Today, medical office is a dynamic real estate sector that has attracted greater interest from the broader real estate investment community. The increased transparency and analytical tools that Revista is building will provide specific insight into the powerful trends that are driving the MOB sector, not only today, but in the future. Both investors and healthcare providers will benefit from the better decision-making capabilities that technology can provide. With Revista, we are on the way to having the data and tools that have been used to great advantage by other real estate sectors. When Revista first approached HTA with this game-changing idea, we were excited to partner with them and offer whatever resources we could. We wanted to help create a product that would serve as a vital tool for healthcare real estate and the professionals in the industry for a number of reasons. As I mentioned before, medical office as an asset class is just now emerging in the real estate community. Medical office represents over $300 billion worth of assets, of which less than 10% is owned by institutional investors. And healthcare insurance rolls are expected to grow by 25 to 35 million enrollees. As we know, the post-Affordable Care Act era, hospitals and health systems are under even greater pressure to provide cost-effective and high-quality care. Medical office buildings play a crucial role in this delivery system, but until now we have lacked a comprehensive database to make informed decisions. Most real estate sectors have seen their values increase as investors better understand the sector dynamics. Revista is the first true industry-wide attempt at creating reliable and accurate data needed by investors and providers alike to help assess the value of their properties. Throughout HTA's history, we have charted new courses and challenged the status quo, always with an eye towards improving our business model, our value proposition, and evaluating the visibility of our industry. Our association with Revista is another example of where we are a part of a sea change that we think will impact the medical office sector today and the days to come. You all know how frustrating it has been to not have objective data to either source, evaluate, or compare assets or transactions. We have long awaited a reliable, comprehensive property database to help our decision-making. We believe that Revista is a technology that will shine a bright light on the value of medical office buildings and improve decision-making for owners and buyers of this asset class. And no doubt it will empower physician groups and hospitals to truly assess the value of their real estate holdings in today's changing healthcare environment. My colleagues and I at HTA look forward to using Revista and doing what we can to ensure it as a viable resource for the real estate and healthcare communities. I want to thank Revista, especially Mike Hargrave, Hilda Martin, Alyssa Freeman, and Jim Levy for their vision and their dedication in creating a powerful database and for their hard work in preparing for this event. At this time, it is my privilege to introduce Michael Hargrave, Principal at Revista.
Okay, well, thanks, Mark. And I'm super excited to be here. Also wanted to send a thanks to Robert Milligan, who's our co-chair of this event from HTA. Also wanted to thank HTA, our diamond sponsor, and HTA is also the sponsor of this session here. And just wanted to state that their support through the building of our database and really the launch of this conference has been critical to us bringing our data to you today, as well as the event here. So we're very thankful to HTA. So I'm going to talk about three things here today, this morning, take about 30 minutes or so. One, I'm going to talk generally about our Revista database, sort of describe it, provide some cuts and some kind of insights into how the data slices up. Two, we have done a brief analysis of the top 10 metros in the United States, the 10 largest markets. And then three, I'm going to talk about two trends that we're noticing in the data that are kind of interesting to think about as we move forward and have discussions throughout the day here. So I'm going to go ahead and start a slideshow here and get things rolling. Okay, so for the last year or so, we have been super busy, but not really out in the marketplace, kind of going to conferences and visiting companies. We've been huddled in our bat cave back in Annapolis, Maryland, building this Revista database. Healthcare real estate is a large sector, and we really spent a lot of time kind of slicing up and defining the property types that we were going to track. We worked collaboratively with our advisory board in terms of exactly how these property types and filters and cuts would lay out. And what we came up with, we just really launched our database recently. We came up with about 51,000 what we're calling investment grade healthcare properties that are across the United States. This is across the 48 states, the continental United States. By investment grade, I mean properties that are in excess of 7,500 square feet. So that's kind of our cutoff for a property that we would consider for reporting purposes in our database. The database includes information on hospitals. Generally, right now we're tracking mostly short-term acute care hospitals. We do have some long-term acute care hospitals as well as acute rehab hospitals, specifically on the transaction side. That's been a pretty active thing that we've been tracking this year so far. In the future, we will be tracking more acute rehab as well as long-term acute care hospitals. The database includes all purpose-built medical office buildings. By that I mean buildings that were built specifically to house healthcare practices, physicians' offices. So we do track all of those. We also track a fair number of medical condo buildings throughout the United States. There are, from market to market, there are a fair share of those. They tend to compete with these MOBs, is what we've seen in a lot of markets. We also track general office buildings that have general office tenants in them, but also have a fair share of medical tenants in the buildings. We call those office with medical buildings. And then we do the same thing with retail settings. So if there's a retail setting that has medical tenants in them, we'll track those buildings as well. And then the last property type that you see there are freestanding emergency rooms that we track. So all told, that totals about 51,000 properties. All those properties are up on our site. You can feel free to search them and pull down certain information on those particular properties. With regard to cutting the data, we right now, the sorts of things that we're able to tag the properties with are, does the property have a surgery center in the building? So many of you think that surgery centers are actually a property type, and there are a lot of freestanding surgery centers out there, but there's also a lot of surgery centers that are in medical office buildings that are combined with other businesses and practices in the building. So we choose to call that a medical office building in that instance, and it has a surgery center in them. So you can search our database that way. Same thing is true with urgent care centers as well as dialysis centers. So we have those tags there now. We are going to be expanding the number of tags that you can search by and filter for in the database. And then we did invest a fair amount of research. We had heard in our early sort of discussions about the sector that this concept of on-campus, off-campus is very important to investors and owners of healthcare real estate. Is the building affiliated? Seems to drive value. So we did spend a lot of time determining on-campus, off-campus, as well as affiliations. And then finally, with regard to change metrics, we do actively track construction and we track transactions. So I'll talk today. The data that I'm going to pull from will come from this database of 51,000 properties, along with these filters, and I hope to bring some insight and some interesting tidbits to you in terms of the data. So let's go ahead and get started. So the first thing you do when you track an industry that has largely been untracked as a dedicated resource before is you got to count them up and slice them up and see what's there. And so we were a little surprised when we first started our research that no one could really tell us or tell me exactly how large this industry was. So how many medical office buildings, how many square feet, what's the aggregate value of the sector? And so we have gone through and counted up our database, and we have figured out sort of what we believe to be with a high degree of accuracy exactly how large the industry is. And here's what we got. So our database, we have a little over 5,000 hospitals in the database, comprising a little over 1.5 billion square feet. That works out to an aggregate value of about $569 billion. With regards to MOBs, or medical office buildings, we have a little over 31,000 medical office buildings. Again, these are purpose-built medical office buildings in excess of 7,500 square feet. We have a little over 31,000 of those, comprising 1.2 billion square feet across the country, and an aggregate market value of about $315 billion. So it's a very large asset class. So you total it up, medical plus hospitals equals about an $884 billion sector. Oftentimes you hear some of the other healthcare property types folded in. The entire sector will be worth in excess of $1 trillion. So it's a very large sector, very large asset class, and we're really pleased to be able to kind of count it up and put these numbers out there and have people use them for investment purposes when they're trying to raise capital to chase properties in the sector. We also are able to figure out from the medical office sector what the ownership picture looks like. We're still determining some pieces of this, but we do have a good accounting of how many properties and how many square feet the real estate investment trusts that are active in the sector own in the sector. They own, to be exact, 8.7% of the MOB sector by square feet. So the U.S. healthcare REITs and REITs that own medical office buildings own collectively under 2,000 medical office buildings, a little over 107 million square feet altogether. That works out to be about 9% of the medical office sector. Another 5% we consider to be owned by private equity, institutional grade private equity. There's a large network of regional developers that are very active, developers and owners throughout the sector. They total roughly about 5% of the sector. So under 15% of the sector we can consider to be owned by sort of these institutional owners. The remaining 85% are owned largely by users. So by users we mean hospitals and health systems, which own a fair share. We believe somewhere over 40%, likely between 40 and 50%. We're still counting up exactly how much they own of the medical office sector. And then providers, actually physician groups and physicians own a fair share of the medical office sector as well. And then government and other owners would make up the balance. So that's a picture in terms of the overall kind of ownership of the sector and how it works out. When we look at one of the key sort of variables in terms of we heard in terms of what really drives value in the sector is the medical office building on campus or is it off campus? So a lot of investors tell us that they prefer to buy on campus or very near campus buildings. So this is one of the ways that we slice up the database. You can see that roughly 25% of the sector would be considered on campus by square feet, but 75% of the sector is off campus. When we look at the distribution state by state of this metric, there's a fair amount of variability across the country. So when we look at some of the markets in the South, like Texas, for instance, over 43% of the space in Texas is on campus, actually. So you have a higher percentage in Texas of buildings that are on campus versus off campus. Tennessee also, 37% of the medical office space is actually on campus in Tennessee. Arizona, which 40% of the medical office space in Arizona is considered from our database to be on campus as well. Then there's markets that there's a lower percentage of space that are considered to be on campus. Markets like states like Pennsylvania, where just 16% of the MOB space is considered to be on the campus of a hospital. New Jersey, where just 12% of the space is considered to be on the campus of a hospital. So if you're only interested in investing in on-campus properties, you're probably looking at Arizona more often than you are at New Jersey, I'm guessing, by this data. We also look at the sector in terms of affiliation. So here we find, with regard to affiliation, we just try to substantiate that the hospital practice or the health system either rents space or has a substantial presence in a particular building. They don't necessarily have to own the building. But when we look at how much of the sector is affiliated, the majority of the medical office sector is affiliated. And this is another driver of value that we see in the database. So roughly 62% of the buildings nationwide are considered to be affiliated. And again, here you see a fair amount of variability state by state across the country. When we look at a market like Delaware, fewer of the buildings are affiliated in a market like Delaware. Only 36% of the medical office buildings in the state of Delaware are considered to be affiliated with the hospital system or a specific hospital. But then you look at, generally, we were a little surprised in the southeast, spreading from like Florida, Georgia, over to Texas. You tend to have a higher prevalence of buildings that we consider to be affiliated with hospitals or health systems. In Georgia, 72% of the buildings in Georgia are affiliated with the health system. So that's higher than the national average of 62%. And then, interestingly enough, I pulled this up for Murray, but 83% of the buildings in Minnesota are considered to be affiliated with the health system. So I think healthcare is pretty big in the Twin Cities area. So that makes sense. It suggests that in the southeast and in a market like Minnesota, that the health systems have been more active in really getting out in the marketplace and establishing presence in medical office buildings than compared to a market like Delaware or something like that. So that's another way that we can sort of cut the database, and we'll be looking forward to doing research on that and sort of how that relates to other things with regard to medical office properties. So I'm gonna talk briefly now about some highlights of the top 10 metros. So we went in and we sliced up the top 10 MSAs, top 10 markets by population. So New York's obviously the largest MSA or CBSA by population. Also has the most medical office buildings in terms of the markets that we track, roughly about 95.8 million square feet. That total square feet is in millions. There's 1,620 MOBs. So interestingly, Washington, D.C., you see at the bottom of the top 10 markets, that's not the 10th largest market population-wise, but it is the 10th largest market on this list, MOB-wise. So there's just 364 MOBs in the Washington, D.C. MSA, comprising a little over 17 million square feet. So in all, we have a little over 6,600 medical office properties in the top 10 markets, comprising a little over 335 million square feet in total. And so when we count them all up, the next natural thing to do is to say, well, geez, how does that look from a penetration metric wise? And so really this is kind of a first look in terms of the amount of square feet per capita. And we can do the amount of square feet per really anything. We're starting to look at the amount of square feet against some of the insured population in certain areas. So, but when we look at the amount of square feet per capita across the top 10 metros, we see a fair amount of variability penetration-wise. So Philadelphia, there's roughly 5 square feet per capita in the Philadelphia metro, 4.8 in the New York City metro market. But you look towards D.C., which again, had the fewest MOBs on the top 10 list. They had the lowest penetration per capita of MOB space, just 2.9 square feet per capita. Overall, in the top 10 metros, it averages out to 4.0%. That's also the U.S. average in terms of square feet per capita, MOB-wise, space across the United States. In Philadelphia, you have roughly 72% more space per capita than in a market like D.C. So that's the amount of variability you have just in the top 10 metros. And we'll look forward to doing this across the country in terms of the amount of square feet out there. So it makes sense if D.C. has a lower penetration rate that it should have a higher level of construction in the market, and it in fact does. D.C. has a number of MOB projects that are either under construction or about to start construction right now. When we total it all up, it equals 9% of existing inventory. So there's a fair amount of construction that will be hitting the market in the D.C. area. And we'll watch that market in terms of how it grows and how how it absorbs that particular construction. When we look at the other top 10 markets, we don't see a great amount of variability. Atlanta has a fair number of projects. We did a profile of the Southeast region earlier this year, and Atlanta is an interesting market where there's a number of the health systems, Wellstar brings up to mind, which are very active out in the market, in the suburbs, building these kind of health parks that are multi-specialty MOBs out in the marketplace. So there's a fair amount of construction in Atlanta. Interestingly, Dallas and some of the Texas markets where we all believe there to be a lot of construction, and there certainly is a lot of construction in some of those markets, but when you measure it against existing inventory, it's not quite as high as DC right now. So the average in the top 10 markets, construction versus inventory-wise, is 2.9%. That doesn't portend future growth in those markets, but it gives you an indicator in terms of really what the volume of new product out there over a certain period of time will be in those particular markets. Okay, I'm going to talk about some brief trends to think about. And this is data that we're pulling from our database, and it's recent data, so hopefully it'll be of good discussion. So I've got a couple of transaction trends, and then I've got a construction sort of insight to discuss. So transactions first. So one thing that we've noticed in our database is we've cataloged several hundred hospitals that we have good square footage information on and we have good pricing information on. And over the past several years, we've noticed that hospital prices per square foot are definitely going up. And this is kind of, there's a lot of variation in terms of price per square foot in hospitals. Not as much variation in price per bed, actually not as much variation as price per bed. So square foot is probably a better metric to look at, I think, if you can. But we did see back in the 2012 period, 2013 period, we saw a fair number of lower kind of square foot, per square foot trades that were kind of pulling the average down. When we look at late 2013 into 2014, we see more skewness towards kind of the high end on price per square foot on hospital trades. There's a lot of specialty hospitals in this mix recently. There's a lot of acute rehab. There's a lot of LTACs. There's a lot of surgical hospitals. But there's also a fair number of general medical centers. Like, for instance, Tenet purchased just in the past few months, closed on the Emmanuel Medical Center, and that worked out to $525. That's in Turlock, California, $525 a square foot, a little over $380,000 per bed. So that's an example of an aged health acute care facility trading for some of these higher per foot values. So hospital prices have gone up in the order of about 25% over the past year and a half when we look at them on a per square foot basis. Okay, so that's one trend. When we look at MOBs, we see prices rising there as well. So this is data. We have hundreds and hundreds of MOB trades that we've tracked over the past several years. Good square footage information, good pricing information, and we also see a similar phenomenon in the MOB space. So we see prices on a 2-year basis going about 16% higher in the MOB space. 2014 average is $286 per square foot. That's up about 8% year over year. It's up about 16% from 3 years ago in 2011. Interestingly, and I'll get into this in a couple of slides, but when we look at some of the ways we slice up MOBs, there's vast differences. So for instance, on-campus MOBs traded in this most recent quarter for $291 a square foot versus off-campus MOBs traded at $256 a square foot. So that's a price differential of about 36% just in this last quarter for MOBs. So we have seen prices rising both in terms of the hospital sector as well as the MOB sector. And what this has led to, it has been compressing yields. So we have a fair amount of yield information. These are more investor yields that we're reporting out. What we're doing here is comparing hospital yields to MOB yields as well as general office yield data that I grabbed from the Mortgage Bankers Association as well as RCA that has a partnership there. And so a couple of years ago, hospitals were yielding, the average yield on a trade was 8.6. The average MOB yield was 7.9. And the average office rate was 7.2. This year, the average yield that we're tracking on MOBs is 7.1. The average hospital yield is 7.3. And the average office yield is 6.8, or 6.9, I believe. So in that 2-year period, to give you kind of a comparison, there's a thought that maybe yields in this sector have kind of compressed a little bit more than they have in some of the other commercial real estate sectors, and this data actually suggests that. So there's over this 2-year period, office yields have come down 30 basis points. So there's been compression across general commercial real estate. But when you look at the healthcare sector, hospital yields have come down about 70 basis points during that 2-year period. MOB yields have come down 80 basis points. So certainly there's been compression yield-wise. I think I'm accurate in saying that we'll probably all feel that out there, and there's some data here that can kind of show that. But alas, when I stand up here on the podium and I announce a 7.1 yield, there's going to be everybody saying, geez, I'm X or I'm Y and I'm Z. And so we understand that, and we know that yields are different depending upon who you are, who you like, where you are, what your temperature is. So we're going to play a game called Pick Your Yield. And so generally, we heard over the years that if you're on campus, if you're affiliated with a health system, if the health system is a tenant, if the REITs pay more, so on and so forth. And this data actually bears that out. So if you're on the campus of a hospital as an MOB, your average yield this year is 6.2%. And this is a fair number of trades in each of these categories that are calculating these averages. If the hospital or health system is the seller, your average yield is 6.3%. If the REIT is a seller, your average yield is 6.4%. And then you have private equity. Somebody needs to go talk to the physician groups. If they're a seller, their average yield is 7.4%, or the investor's average yield is 7.4%. And then you go down to the office, off-campus, not affiliated, and anybody who's not buying, or anybody who's buying that is not a REIT, tends to get a higher yield on transactions. And so there's a great amount of variation yield-wise depending upon exactly what you're looking at transaction-wise. And so you really have to look past the averages. Okay? These slides, I believe, are available for download. So, and if for some reason you can't access them, just let me know. I'll send them to you. Okay, the other thing I want to touch on is healthcare construction. So we are tracking healthcare construction, and you can see from this trend, this is data from the Census Bureau. They do a good job of tracking the value of construction put in place. They do it for commercial real estate. They do it for, they break it out for office properties, and they break it out for healthcare. And so, back in the 08 period, 07 period, there was a fair amount of healthcare construction. There was, on a relative basis, there was more commercial real estate construction. There was more office construction. Going through the recession, office construction really kind of tailed off. Healthcare construction tailed off, but not as, not quite as much. And it's been running an annual rate of about $40 billion value put in place. And so it's hard to tell from this data if construction is picking up or construction is rising. I will tell you that as we look at construction throughout the sector, it seems like there is a lot of activity. That we measured in the top 10 metros, we measured about $27 billion of product that's under construction right now in the top 10 metros, and that's hospitals, MOBs, a lot of different variations of those property types. But with regard to MOBs in particular, we've tracked so far. We've tracked almost half the country in terms of the construction activity out there. We hope to finish the rest fairly soon. And so far we've completed the top 10 metros. We've completed the Northeast region, the East North Central region, which Chicago is in, and again, we believe that's about half the country. We have a little over 5 million. 5.5 million square feet of MOB space that is scheduled to open this year within those areas. Also within those areas, next year we have about 7.8 million square feet that's scheduled to open next year. So at least in those areas, we do see kind of construction activity picking up a little bit. Now, we would be nowhere near saying that this is a high level of construction or an alarming level of construction or anything like that. We tracked in our database in 2008, we're still putting together our inventory graphs, but in 2008, that was sort of the high watermark recently in terms of inventory growth MOB-wise. We tracked over 21 million square feet across the sector being delivered in that particular year. So this is nowhere near, even if you doubled this, saying this is 50% of the country, that's nowhere near previous levels that we saw several years ago. So, but it gives you an idea in terms of construction activity starting to pick up, and we'll look forward to tracking this going forward. So, I'm going to stop there. If there's any questions, I think I might have time to take one or two questions. Is there any? No? Okay. So I answered everybody's questions. That's good.